Following nearly 4 years of absurd price growth, virtually everyone in the US is now fully aware of the bubble that's brewing in the housing market. Prices that were already starting to get high in 2019 began to explode following 2020, and today, nearly 4 years later, a typical single-family home is 50% more expensive price-wise and more than 100% more expensive payment-wise. This double whammy of rates plus prices has left the American public scarred, killing off what was previously called the American dream. Today, most young Americans find themselves in a challenging dilemma: either accept the burden of overpaying or patiently wait for a seemingly elusive market downturn. And this brings up the question, will this bubble burst, and if it does, what will trigger it? To many experts, emerging indicators suggest that the housing surge that followed 2020 is approaching its final chapter, and the ensuing fallout could potentially dwarf the relatively minor setback experienced in 2008. What's coming may be the Great Housing Depression. To understand just where we stand today and how incredibly dangerous the situation looks, we first need to understand the last housing crash in 2008, as understanding it provides a proper foundation for understanding a future one. You see, just like today, the common belief prior to the Great Recession was that housing was an indestructible asset class that only rose with time. Even in the moments prior to the last big crash, it was the common belief that home prices had reached a new paradigm. This was now a new plateau, and it didn't matter that houses were much more expensive than the typical historical average. Experts claimed that this was just the reality of the new future, and home prices were just going to be more expensive in relative terms compared to what Americans were used to in the past. These types of comments are exactly what we're hearing today. In fact, on June 30th, 2005, 1 year before the '08 housing crash began, Fed President Ben Bernanke was asked by a CNBC reporter about a potential housing crash following years of unprecedented price growth. And of course, he quickly dismissed the possibility, saying, "We've never had a decline in home prices on a nationwide basis. So what I think is more likely is that home prices will slow, maybe stabilize." 24 months later, the country will undergo something that was previously believed to be impossible: a nationwide housing meltdown that would devastate the economy for over a decade. This event proved that housing was a potential weak point and prices are vulnerable to severe downturns. Now, a lot of people will hear that and say, well, despite the fact that today we're seeing a lot of the same absurd price growth, 2023 is completely different. The common argument is that the '08 crash was caused by bad loans, and this time around, we don't have that. In fact, that's the whole basis of the anti-crash theory. The entire foundation for the housing bulls is that '08 was an outlier, a crash caused by greedy banks giving loans to poor people who can't afford them. But that narrative is wrong. In fact, everything you know about '08 is likely wrong. The truth is, many of the same problems that plagued the market before the '08 crash are found today, and the true nature of that crash is very simple to understand if you just take a moment to zoom away from the common media narrative. Now, before I reveal the true cause, please take a moment to help out a different cause. Please take just 2 seconds to hit that like and subscribe button if you're enjoying the video. Each like is fuel for the algorithm that helps support this channel. Thank you. Now back to what I was saying. You see, the '08 crash wasn't caused by bad loans. It was caused by speculative, greedy investors. And worst of all, these were not the big bank investors. It was the medium-sized house hacker influencer type that inflicted the most damage. These were investors who owned 4 to 15 properties, preying on what was then a speculative frenzy similar to what we see today. And this isn't just me saying it, there is strong evidence to suggest that this was the exact problem that broke the market. When people talk about 2008, they are obsessed with subprime. Subprime became the center of the narrative for the entire Great Recession. There were movies made about it, countless articles, congressional hearings, and even trials. But as the years passed on, more and more evidence started popping up that subprime maybe was not the issue at the core. Now, subprime refers to loans that were given out to people with low credit ratings. These were often adjustable rate mortgages, also called ARMs, and their popularity in the early 2000s was what most experts blamed the bubble on. Today, subprime loans make up a tiny percentage of the overall loan volume. They are no longer in the mainstream, and because of this, many believe that we are immune from a crash like 2008. But if you dig past the headlines, you'll find that subprime was never the truth behind the crash and had almost no correlation in inflating prices. In a 2022 study focused on the causes of the '08 crash labeled Villains or Scapegoats, the role of subprime borrowers in driving the US housing boom, the authors argued that subprime borrowers, aka poor people, were wrongfully blamed for the entire recession. Dig into the data and you'll find that the '08 crash had nothing to do with ARMs and ninja loans and everything to do with investors and speculation. In academia, the perceived theory was that the expansion of credit supply to marginal households was a chief determinant of home price growth during the 2000 to 2007 period. This just meant that loans and how easy you were able to get them in that early 2000 period was the primary reason home prices exploded. But what the authors find is that this cannot be the case. If this were true, a researcher looking at these trends should see higher home price growth in areas that experienced high growth in subprime purchase mortgage activity. However, the data presented suggests the opposite. In fact, there is actually a negative correlation between house price appreciation and growth in subprime purchase market share over this period. That means the higher the amount of subprime buyers there were in a particular area, the less it meant that home prices in that area grew. To make it clear, the researchers found that a 1 standard deviation increase in the subprime share of purchase mortgages between 2002 and 2006 is associated with an approximately 4% decrease in house price appreciation over the same time period. Now we can talk about the paper for days. It contains hundreds of pages of data providing all kinds of details regarding their findings, but ultimately what it concludes is that the housing price boom and the subprime purchase mortgage boom occurred in different locations. Counties that experienced high house price growth were those that experienced a disproportionate decline in purchase mortgage lending to subprime borrowers. So if it wasn't these poor borrowers, who was it? Well, the evidence shows that it's more likely that the dramatic rise of investor purchases during the boom period was more likely to blame. Speculative behavior, which was fueled by owner occupancy fraud and appraisal inflation, led to the massive troubles we witnessed in the mid-2000s. And these were not subprime borrowers. These were mainly prime borrowers who exploited loose borrowing loopholes that led to a massive increase in leverage. If you really sit there and think about it, the vast majority of poor people, even if they buy an overpriced home, do so with a strong belief that they can make the monthly payments. A man with a family will do everything in his power to keep his house, and even with subprime rate adjustments, the differences in payments were never enough to put someone so far under that they willingly gave up their home. People that actually live in the home they purchase have a strong incentive to keep it. Losing your house is one of the most embarrassing and sad events anyone could go through, and people fight hard to avoid that, even if it means getting a second job, a loan from a friend or family member, or some sort of deal with the bank. Banks know investors have less incentive to pay once times get bad. Primary residents do not, and this concept is exactly why 2008 happened. It was blamed on the subprime borrowers, but in reality, it was the prime investors who abused the system and created the mega bubble. Today, we're seeing growing evidence that this is happening again, and the new bubble will be popped in the same way the old one was: investor greed. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it.